This correction that we've been writing about for 2 weeks is here. We've started the correction. The question is how far does it go? Where does it bottom? And where's the next buying opportunity? That's what we'll be talking about.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good and Kakekian friend, Lance Roberts. How you doing, Lance?
I'm doing good today. All right, you got me on that one. I don't know what that word means.
Yeah, it's actually a medical term for wasting away, because I'm on day 4 of another one of those fasts. And when I was preparing this arc last night, I was just intensely hit by just a lot of hunger. And so I was feeling pretty bitter about it. So anyways,
Well,
wasting
don't
away
worry.
is...
Let me just tell you right now, I'm right in there with you. So I made a terrible mistake about a month ago, which was my son and daughter. They're 21, 22 years old now, but they wanted to go see the new Deadpool Wolverine movie because we're big Marvel fans from way back, and so they wanted to go see the movie. So I was like, yeah, I love Deadpool and Wolverine, so yeah, I'll go with you. And very funny movie, but Hugh Jackman is close to my age, so I'll be 60 this coming May. He's, I think, 55, 56. Don't quote me on his age, but he's close to my age.
He's between us because I know he's older than me, and I'm 53. Yeah.
Yeah. So he's between us anyway. So he's completely shredded in this movie, and so when I got home, I looked up his workout routine and his diet, and so for the last month, I've been working this workout routine and working out this diet, and I am sore and I'm hungry all the time. It's working really well. I mean, I've lost probably about 7 pounds. Most of that's body fat over the last month, but a lot of that was just getting back from the vacation I took where I didn't worry so much while I was in Greece. So I'm right there with you. I'm hungry all the time right now, so I'm there with you.
All right. Well, now you're just going to have to, in a month, do this sleeveless and show us your Hugh Jackman jacked biceps there.
All right, we can do that. We need to start a whole health and fitness segment of Thoughtful Money, and so we'll just share workout routines and diets and things like that.
Well, it's funny you say that, just because on this day of all days, because one of I do a lot of workouts off of YouTube. There's a lot of really good quality program available for free off YouTube. And one of the channels that I've been doing for years, I just got the contact info for the guy that runs that channel. And I sent him an email about an hour ago saying, hey, I'd love to have you on Thoughtful Money at some point in time, because we talk about wealth. It's usually money, but there are many other important forms of wealth like health. And so anyways, he might be on the channel soon.
Nice.
All right, but anyways, let's get to the markets, which is what everybody got on here for. And wasting away might not be a bad analogy for the markets over the past week, at least. They've had a pretty rough week. We've got a lot of data to talk about today, and maybe we start there. The jobs market, as you and I have been talking about for the past couple of years, Lance, that we had strong suspicions that it was perhaps not as rosy as the official data was telling us. I feel like we're probably vindicated here that there's been a lot of big dramatic write-downs recently that we've already talked about that have shown that things, yes, were in fact not as good as the official BLS data was showing us. And then this week we've gotten kind of a drumbeat of bad jobs data, and we're talking actually on Thursday, not our usual Friday time, because I have my 25th business school reunion tomorrow that I had to go to, and you were kind enough to move the recording time here with me, Lance. And there's one more big report this week that's going to come out tomorrow, the payrolls data. And folks might remember last month when it came out, it really freaked everybody out because the SOM rule got triggered, and all of a sudden everybody was worried that that bulwark against recession, the employment market, was maybe beginning to crack. And anyways, this week we've had disappointing bad JOLTS data. We've just this morning got bad, disappointing data from ADP. So I've got a little bit of additional color to add to this stuff, but let's just start there, Lance. How material is this new drumbeat of disappointing jobs numbers? After a very long string of blowout jobs number, yeah, of course we're revising down the previous numbers, but man, this month was awesome.
First of all, as we were talking about this morning on the Real Investment Show, is that right now there's a big bet on the 10-year Treasury yield moving towards 4% over the course of the near term. Now, in order to get yields to move from 3.7 to virtually 4%, you're going to need a slate of economic data that would potentially change, at least in the market's mind, the idea that the Fed's going to be cutting rates near term, right? So what would that be? That would be a employment report that comes in just gangbusters tomorrow. Like we have a 400,000 job print tomorrow. Inflation reports are next week. So if we get an inflation report that is hotter than expected, that could potentially start moving up yields towards 4%. Now, I would expect that to occur. Bonds are extremely overbought near term. So trying to buy bonds here, and I talked to you about this a couple of weeks ago, trying to buy bonds over the last couple of weeks has not been a great bet because they're so overbought right now. We need a correction in yields and ultimately a correction in bond prices to provide a better entry point. Well, in order to get that correction in yields, you're going to need some event to cause bond traders to come off that trade. So that's going to be very likely here over the next, course days. So the point here is don't be surprised if tomorrow we get an exceptionally strong employment report, because that's kind of what the market, the positioning in the bond market is suggesting. We'll see if that's right or not. But now, but in contrast to that data, we just had ADP out this morning that showed about a 90,000 job increase. So now there's not been a big correlation between ADP and the BLS report as of late. So again, you can't really put a lot of weight on the ADP report and what that's going to mean for the employment report. But one of the interesting reports this week was the JOLTS report. And again, this is another one of those numbers. So the job opening and labor turnover survey report, that's the JOLTS report. And we've talked for a long time about the fact that there's, JOLTS wasn't really relaying what was going on in the job market because a lot of companies, so there's what's called labor hoarding. And after we shut down the economy, a lot of businesses started hoarding labor. If I've got a really good employee, I don't want to let him go. And there was a lot of poaching that was going on between companies. So as a company, what do I want to hire? Do I want to hire the guy that's unemployed because he lost his job? Or do I want to hire a guy from another company that held his job during the economic shutdown, which means he's probably a really good employee? So what companies were doing is they were posting job openings, and you hear this a lot in the reports from people applying for jobs. It was like, hey, I sent out 100 resumes. I got 0 responses, but there's all these job openings, right? But nobody's really hiring. Well, that was because companies would put out a job posting saying, I want, an employee for this job. They weren't really looking to hire somebody for that job. What they were looking for is for the employee at another company that was really good at that role that goes on to Indeed or Career Builder, et cetera, looking to move jobs. And so it was more of a bait job posting than it was an actual job posting. So that was what was causing a big elevation in these job openings. Of course, you always have job openings for restaurant workers and waitresses and waiters and hostess and hosts for restaurants, because those are big turnover jobs. But there were a lot of other jobs that were posted, but not really intending to hire for that immediately. It was more of a, hey, it's like an advertisement. If you're a really good employee with another company, we'll hire you if you come over and we'll pay you for it. Right. Well, now those job openings and that job opening labor turnover surveys had a very big decline because now those job postings are getting pulled, and we're seeing lots of negative revisions to that data. Now, here's the interesting point about this. There is a very big correlation between the ADP the JOLTS report and the S&P 500. And so if you take a look at this chart as an example, so this is the job opening labor turnover survey versus the S&P 500 going back to 2002. That's as far back as the data goes.
All right, and
what
just
you'll
so
notice
folks,
is,
just to help folks here, the S&P is the black line here.
Yes.
The blue line is the jobs data. Yeah.
Correct. Thank you. But what you'll notice is obviously is this huge, gap has opened up between the job opening survey and the market just over the course of the last couple of years, really since October of 2022 more than anything else. So, what is interesting right now, and we're seeing this on a couple of different fronts, is that we're not seeing earnings and estimates really kind of keeping up with the overall market. In fact, what this chart shows is this is economic surprises in the light blue. The red line, the economic surprises is the red line. The dotted blue line is sales surprises. So that's what happens at the top line of income statements for companies. And the dark blue solid is earnings surprises. That's what happens at the bottom line. So earnings have been doing well because of buybacks, accounting adjustments, and all these type of things. But what's happening at the top line, and along with the economic data, has continued to erode. And so we've talked about for a while is that the underlying economic factors are a lot weaker than headlines suggest, and that will ultimately feed back into earnings at some point. And we're seeing those earnings estimates coming down. And at some point, if earnings don't meet these rather lofty expectations that Wall Street has out right now for going into 24 and 2025, then the markets are going to have to reprice for valuations because valuations are price times earnings. So right now you've got the market is very, optimistically priced for earnings growth that the economic data really doesn't support.
All right. So you've just talked about a couple of really important things there. These are great charts, by the way. So yeah, we can use the job market as an analogy here, or a parable, where the headline data has been saying everything's been fine. We've been sort of sniffing around the edges and saying, we really don't think so. And now we're beginning to see increasing data that suggests that it really wasn't the case, that the gangrene that we smelled, we're now actually able to see on the body, right? You're saying somewhat similar actually on the corporate income statement side as well, where revenues are telling us that, hey, things don't look that great here, but earnings have been saying, no, everything's fine, right? And one of those two things has to be right. And we know, that there's all sorts of accounting chicanery in sleight of hand that can keep earnings looking better than they should be for a long time. But again, reality eventually has to re-express itself here. So, we talked earlier about that, what precedes a dramatic market shift, change in trend, is a sentiment shift, right? And it's when, I'm going to borrow from Ben Hunt here, but it's when knowledge that was previously private, like we thought it in our heads, but we weren't talking about it publicly because we weren't sure everybody shared the same opinion. Once that all of a sudden becomes common knowledge and we realize everybody thinks the same thing, then the herd sort of shifts, right? And of course, the famous parable of this is the emperor, had no clothes, right? Nobody wanted to say anything until the little child says it, and then everybody says, "Oh my God, that's right, that guy's naked," right? And I talked about how we just went through this as a nation with President Biden, right? We're right leading up to the debate with Trump. He was fine, everything was great. Any questioning of his mental faculties was, rank, partisan, made up stuff. And then right after the debate, the sentiment changed in the Democratic Party. And they said, we got to replace this guy, right? And so, that data that you just showed really gives me even a greater sense of confidence that at some point here, something's going to happen. There's going to be some trigger that's going to shift private knowledge to common knowledge, where everybody says, you know what? This economy is far weaker than we've been sold. And at a minimum, we can no longer price it to perfection, right? Now, when's that going to happen? Who knows? It could take a lot longer than we think. Your whole point, don't just go into the bunker, because of this. But, I see data like that and I'm like, oh, yeah, all right. The people that are nervous and quote unquote bearish have a good reason.
Well, yeah, but again, you have to separate out what this actually means too. And I don't disagree with you, right? I mean, the data certainly says that, markets are well overpriced here, but that doesn't mean, a 50% correction in the markets, right? You can solve a lot of this with the market going literally nowhere. In other words, we spend 2 years of a market that just grinds sideways up and down. and you'll solve a lot of these problems. So, again, this is why it's always important not to, assume that every moment that, the floor is going to fall out under stocks. And so it could. I mean, that there's obviously periods in the past, the financial crisis and the dot-com crash that have certainly occurred. And there's some exogenous factors around those two markets. Go back to 1974, you had another big, decline in the Nifty 50. So there's certainly, and I don't want to dismiss that there's certainly events out there that can cause that. But, what's also important to understand is that, yes, we can resolve a lot of this by simply just trading sideways for a long time.
Right. And just let you know, I agree. And I'm not trying to push the panic button here at all.
Yeah, and I just want to make sure that message is getting out because, because we are talking about some things that are more bearish in nature. And again, that's my job. We have to analyze the bullish and the bearish, and try to figure out what markets are going to do. Mike Leibowitz just posted a really good article on our website, and in fact, I'm following up on that in our weekly newsletter this weekend, talking about yield curve inversions and un-inversions. And of course, it was interesting this week with the yield curve uninverted, mildly. I mean, barely.
Yeah, and just to be clear, which yield curve are you talking about there? Because there are many.
The 10 and the 2, the 10-year.
Okay, the big one. Yeah.
Yeah. But there's a few others. We track 10 different ones, and about 30% of them have uninverted now. We've still got a very high level of inversions, but we're starting to see more and more of these yield curves uninvert. Well, so immediately two narratives come out, right? So CNBC puts out a headline that says the yield curve normalizes, no recession. Okay, so clearly
soft landing and no landing achieved. Yeah.
Exactly. And that's the thought, right? So we had this inverted yield curve. We didn't have a recession. So now we're back to normal on the yield curve. And so everything's fine. The other side of the coin is as we've talked about specifically, is that the trigger for the recession is the uninversion of the yield curve. So when the yield curve actually uninverts, that's normally the trigger for the countdown to the recession. But therein lies the rub. Doesn't mean the recession starts today. In 2008, it was 280 days from the uninversion to the recession, but that's not the real story. Because see, in 280 days, we actually got into the recession after the inversion, but we didn't know we were in a recession for 12 months later.
Right.
Because the NBR didn't date it. So actually, it was almost 600 days, actually a little over 600 days, before we actually knew we were in a recession. Even Ben Bernanke in March of 2008 didn't know we were in a recession. He says everything's fine. It's a Goldilocks economy. Subprime is contained. That's March 2008. December, NBR announces the recession started in December of 2007, 4 months before Bernanke's famous words. And so here's your chairman of the Federal Reserve going, everything's fine. Don't worry about it. It's a Goldilocks economy. So, the uninversion of the yield curve is very important to pay attention to. And it has an impact on the outlook for earnings, for the economy, for stock market participation, for gold miners, for all these type of things. And so, when we look at all these underlying factors, and then more importantly, look at the correlations between assets, it tells you that there's a lot of risk potentially for markets over the next 24 to 36 months. And so therein lies the rub. Everything is fine right now, but this market can remain bullish for another 12 or 18 months before we actually get to the point to where the inverted yield curve matters, where the slowdown in the economy matters, and all those type of things. And so timing, Howard Marks once had the greatest line. He said, being early is the same as being wrong.
Right.
And that's very important when it comes to investing, is that timing is the most crucial aspect to all of these market calls. It's great to have these macro market thesis that, the market's about to crash. But if it takes 24 months to get there and the market's up 50% between, I'm not saying that's the case, but just assume this is the case. Markets are up 50% between now and when the event occurs. The event occurs and the stock's correct 30%, great. You potentially miss the downturn of the 30%, but you're still behind the ball because you missed the 50% run up beforehand. And so this is what happens to a lot of investors, is they make these big macro market thesis calls in their portfolio that are way too early. And again, as Howard Marks said, is being too early is the same as being wrong and making a bad call.
Yeah, and I hate to use this other analogy because it blew up so spectacularly for the guy who said it. But Chuck Prinz, who said, hey, when the music's playing, you got to be on the dance floor. Um,
Mhm.
uh, but your job as a capital manager, right, is to get a good risk adjusted return for your
Right,
clients, right? And so your job is to deal with probabilities, right? That's
right.
really all you're doing, right? It's just assessing probabilities all the time. Okay, given this new data, does that change anything in terms of likely outcomes? Um, I've got to imagine that the data that we're talking about right now is just influencing you to say, all right, look, I'm not leaving the dance floor, but I'm maybe taking a step or two closer to the door because of this, because probabilities are shifting a little
Mhm.
more to the negative here, right?
Yeah. And again, but and to your point, that's exactly what we've been doing, right? So back in July, we reduced our exposure to big cap tech stocks before the correction. And on this recent rally before Nvidia reported earnings, we reduced our Nvidia positions more. We still own it, but we've reduced that position. And from our original purchases, we no longer have any of our capital in it. We talked about this before. But a good example is today, right now. So we're talking on Thursday. We'll see what happens tomorrow on Friday. But just as a good example, the markets are down about 90 bips or 9 tenths of 1% right now on the S&P, but our portfolio is down about 0.4. So we've got a much lower beta volatility, and beta volatility is just simply how much does the portfolio move up and down relative to the benchmark index. So, what our goal is to reduce that volatility over time so that, if markets correct and you have a downturn, then the portfolio does a little bit better than the markets because I'm not as concerned if I underperform the markets on the way up, that's okay. If I can avoid the downturns to some degree, or at least minimize that downturn, I spend less time getting back to even. So a really good example of that is year-to-date performance. The S&P is not back to all-time highs, but our portfolio is actually trading at all-time highs as of yesterday. It's down a little bit today, but we were at all-time highs yesterday on the portfolio for this year. So, as a function, by minimizing those downturns back in April, we sold before the correction back in April. We were buying, near that bottom back in April, and just navigating kind of this volatility. And these aren't big moves, mind you. We're very small percentage moves. We're trimming from 2.5% positions to back to 2% positions, or we're trimming from a 3 to a 2. These are small moves. There's a great saying about football. Football is a game of inches. If I can just keep moving the ball down the field and keep making first downs, I can score. And baseball is the same way. All I got to do is just hit a bunch of singles, and I can win a baseball game if I can just keep getting people on base and keep knocking them around the bases. Invest the mistake that investors make repeatedly over time is making drastic moves. I've got to be all in this asset or all in this asset or be out of
Right.
the market entirely. And that's where as we were talking about with Howard Marks, so that's where being too early is the same as being wrong, because yes, I can get out of the market and I can avoid the eventual downturn, but people have been expecting a 50% crash in the markets for 3 years now, and the market's up 100%. So how much did you lose trying to wait for that eventual downturn to be right? And again, our goal isn't to be right. Our goal is to make money.
Yep. Yep. No, exactly. Okay. Well, look, a number of other topics here, so I want to keep on moving, but
Yep.
just to
Yep.
talk, just to put a bow on the job stuff, the JOLTS data, um, is a disappointing report this week, and of course they went back and revised last month's data as well, and
But that's been the case for like 6 months in a row now too.
it's
So
been the case for 6 months. But what I just want to note about this last revision, because I think it's emblematic of what's been going on. When last month's data came out, it was touted as a beat. Now that they've revised it down, the revised numbers are now lower than what the expectations were a month ago. So it's actually now a miss, right? So
right.
again, it's underscoring the fact that we've really been told that things are much better than they truly are. And it makes you wonder, okay, everyone's sort of noting that this is a disappointing number. This still could get revised down, right?
Yep.
The ADP number that we just saw is the lowest since early 2021, right? So we're really beginning to see, this is not the world ending. But these cracks are entering the moderate to strong range now at this point, right? So it's going to be really interesting to see what happens with tomorrow's payroll numbers. By the time folks are watching this video, they're going to know. Um, uh, I totally get the point you're saying is, hey, looking at how the market is priced right now and bonds being particularly overbought, you wouldn't be surprised to be some trigger that gives the market an excuse to drive yields higher. I totally get that logic. I'm just thinking with all this other data we're seeing right now, if they came out with a blowout payrolls number tomorrow, would anybody believe it? Especially after they just revised 2023 down so substantially, but flying in the face of all these other data points?
So that's a great point, and and something we've talked about before. It doesn't matter whether you believe it or not, right? And this is the one thing, and there's one important point about economic data that everybody watching this video needs to understand. Here it is. Nobody cares what you think, right? Whatever you think about the economic data, good, bad, or indifferent. Oh, I don't believe the inflation number. I don't believe the employment number. All the books are cooked. Maybe. Doesn't matter. All that matters is what the market thinks. And the market's going to trade off that data. So again, if the employment number comes in at 400,000 on Friday, bond yields and stocks are going to trade off that number on the expectation that the Federal Reserve will not cut rates by 50 basis. Right now, there's about a 50-50 split on whether or not the Fed will cut 25 or 50 basis points this month.
Right.
So if that number is super hot tomorrow, that's going to shift those odds to a 25-point cut. That will probably lead to a big jump in bond yields and a decline in stock prices because of less monetary accommodation. That's all that matters. Now, whether or not you believe the number is irrelevant. You can believe whatever you want. I'm not saying that your belief is right or wrong. I'm not saying that at all. And look, I look at the numbers just like Adam does, and I go, that didn't make any sense. I've written articles about what's wrong with the employment data, what's wrong with the retail sales data. You can go to our website, realinvestmentadvice.com, type in employment. You're going to get numerous reports about the employment data and everything that's wrong with it. But that has nothing to do with how the markets are going to respond to it.
So let me ask my question in a slightly different way, because I agree with you.
Yeah.
The market does not care what Adam Taggart or Lance Roberts thinks about this stuff. My question was, will the markets believe it? And maybe they will still at this point in time. But I guess the meta question is when do you get to the point where the market calls BS on some of the data that's just so clearly not fitting in with everything else?
Yeah, you won't get there. There's not going to be a point where the jobs number comes out and the market, pukes because they don't believe the number. It'll be because the employment number comes out, but wage growth. Again, you can say you hired this many people and have a whole bunch of people hired, but if wage growth is declining because you're hiring all these people, right? The more labor supply I have, the less I have to pay for them. Right. And we're seeing this right now. Remember, we had this big surge in wage growth back in 21 and 22 because there was a demand for labor, but nobody was working because everybody's getting paid to stay home. Now what we're seeing is corporations, the same jobs that were being offered for like computer programmers, et cetera, a couple of years ago are now being offered at $30,000 less a year. The benefits that were being paid out before, hey, come work for me. We'll give you a signing bonus. We'll give you a new car. We're going to give you extra time off, whatever. All that's gone away now. So they may not be cutting the wages, so to speak, but they're cutting all the other benefits that go along with it. But we're also seeing a decline in actual wages. So wages are starting to come down because there's more and more labor supply available. And so that's what the markets are going to really, great. You hired 500,000 people, but you're paying them all less and they're all working for, 2 hours less a week than they were before. That's what the markets are going to really focus
on. All right, Lance. Well, I just want to note that there is a headline out there about some traders. They're anonymous right now, but they've put millions on the line with a bet that tomorrow's payroll report is going to be so hot that it's going to drive the 10-year up to like 4.05. So there are some people out there putting some serious money on this. So we'll see. And again, when folks are watching this video, they'll know if those guys actually made their nut or not off of that.
But I'm not betting on that, right? I'm not making that bet. We're not adding, but like I said before, is that we're going to add to our bond portfolio and shift our duration longer, but bonds are so overbought technically right now. We've got to have a correction, and something will cause that. It could be the employment report tomorrow. It could be a hot CPI report. It could just be bond traders just you know taking profits. But something is going to bring yields back up towards 4%, which will give us a better opportunity to uh, shift duration out in the portfolio.
Okay. All right. Well, we'll see what happens. And of course, we'll be tracking the whole employment thing going forward. And just a reminder to folks, a lot of folks have been asking if I can get Michael Cantero back on the program. Folks, I have reached out. We're working on that. But we've talked a lot about the importance of that employment domino being the bulwark between whether the economy goes into recession or not. That's what the whole HOPE framework stands for, HOPE. You fall into a recession when each of those dominoes falls. So far, the E has not. We'll see what happens going forward. But Lance, I want to move on to now, what's actually happening in the general markets themselves. I do want to get back to bonds with you in just a moment. Real quick, though, I realize we haven't talked about the visible elephant in the room here, which is that you are in a completely different room. I think you are now in your home office, but it's still being assembled, right? So I know there's some issues visually with audio, whatever, that are still getting tweaked. Yeah. But you are now officially in what will become your new home studio, right?
We're getting there. Yeah, I'm missing soundproofing right now. I've got this big giant window that on this side over here, and this one I have sun on this side of my face. I've got this big picture window that overlooks this beautiful Catholic church. So I've got to be really good when I'm in my office because God's watching. But I'm waiting for blackout blinds to show up, and so yeah, just a few pieces of the last little bits, but over the course of the next month or so, we should get everything worked out.
All right, cool. Well, it's definitely looking very high tech. I'm sure folks are going to be giving you lots of kudos and feedback in the comments below. But anyways, congratulations. I know that the move to a new studio and the building of a new studio, takes a lot more time than people realize. All right, so there are a series of articles that you and your colleague Mike Leibowitz have been writing there over the past week or two at realinvestmentadvice.com. There was an article we were going to talk about last week. We just didn't get enough time to get to it, and we did earmark it to talk about this week. That was called Overbought Conditions Set Up Short-Term Correction. And, maybe that was prophetic. Who knows? Markets, I mean, they're still doing pretty well, but they have been, they've had a rough week in general. And then you also wrote a piece, Risks Facing Bullish Investors as September Begins. And then Michael had a piece, and I think you've already referenced it a little bit. There might be more to say about it. Bull steepening is bearish for stocks. That's a two-part article that he's written. But I kind of take all those three things together to say, you guys are maybe, seeing clouds darkening on the horizon. Again, you're not predicting a market calamity, but you've sort of been saying, hey, look, it looks like things might be a little rougher going forward from here. And that would be completely consistent with what you've been saying for many months here, which is that you expect as we turned from the summer, into the fall, heading into the election, markets were going to start to de-risk. There's going to maybe be a little more volatility. So what we're seeing right now seems to be kind of happening right on cue to the script that you thought was the way it was going to play out. Let's talk about that. Maybe at some point bring up the S&P chart so you can show us where we are on the technicals. But let's also talk about Nvida, because we've had a lot of conversations about how important the exuberance of the AI trade has been to the market action over the past 2 years, really. And it's created a ton of market cap, especially in the Mag 7 companies. And I and others have raised the concern that, hey, if the bloom starts coming off the rose of AI, how much of what's priced into the stock market right now really is phantom market value that could go away relatively quickly if folks start to sour on AI. And what's interesting is that, of course, the bellwether stock for this whole movement has been Nvidia, which really has been the bulletproof stock, can do no wrong. And it's had a rough time. It's down, 15% or more from its recent highs. And what's notable about the stock in the near term here is that they just had their earnings call. They had blowout earnings and revenue, so they didn't disappoint, and talked a good game about forward guidance. But
Right.
very notably, their profit margins didn't grow. In fact, they shrunk for the first time since this whole AI bull market has started. And that may be giving the market pause of like, we priced this thing to perfection, like kind of ever increasing profit margins, ever increasing revenues. And maybe the ball has hit its apex, and coming forward, maybe it's going to start decelerating from here. And then there was a headline a couple of days ago that the Department of Justice is looking into bringing antitrust action against Nvidia. Now that's happening against a number of other big tech companies right now, so it's not unique to Nvidia. But the point being is there's increasing, and of course, there's if you look at searches for AI, Google searches from AI, they peaked last year and are on their decline. You're seeing more and more headlines questioning, hey, almost $1 trillion's gone into AI CapEx spending. What are we really getting in return? So not saying the party is over yet, but I think we're seeing an increasing amount of signs that the party goers are maybe beginning to kind of start to sober up a little bit here. So as we talk about the future of the market, I just would love to get your thoughts on whether you think we're seeing anything really material happening on the AI trade, because that obviously could have big impacts as well.
No, not really. I mean, the AI trade is still growing. It's got tons of room to go yet. It's very early in that overall trade. All the things you pointed out are obvious. Issues. Margins are going to slow simply because of size. It's a function of the law of large numbers. When Nvidia was $1 billion company in revenues, it was easy to grow from 1 billion to 2 billion and double your revenues. When you're 30 billion a year, it's a lot more challenging to grow from 30 to 60 billion. But the earnings growth is still far outpacing that of pretty much any other company right now. And really, if you take a look at the stock, technically, all it's doing is consolidating its gains. You got to remember, yeah, the stock's off 15% from the peak. It's up 144% since the beginning of the year. It's up 900% since October. So, yeah, you're going to get a correction every now and then, and that's certainly very feasible. But when you've got to start making the argument that the Mag 7 trade is over in general, and that's going to be a really hard argument to make because of simply corporate buybacks. They just announced a $50 billion buyback in addition to the buybacks they were already doing. They're in the top 10 holdings of the S&P, so they get 37 cents of every dollar goes into the top 10 stocks of the S&P when indexing, and we have a vast number of people indexing, stocks now. So, they're going to continue, those Mag 7 will continue to get fed because they're highly liquid. So portfolio managers need a place to hide that's easy in and easy out. So they're going to continue to get fed by large cap managers, in particular hedge funds, mutual funds, pension funds, et cetera. They're going to buy these stocks. So the narrative of AI is still very much intact. The outlook for AI is still very strong. And that's going to start to shift through more and more companies as companies have to move towards AI to compete. We just heard from Walmart recently talking about the importance of AI to their business. We're seeing it with Target. We're seeing it with Amazon, the importance of AI in their business, not just the cloud side, not just the cloud services side, but importantly in how they manage their business. And as AI gets further and further developed, which it will, it's going to become integral to small cap, mid cap companies in general, just to be able to compete in terms of creating profit margins. Because in an environment where you have a deflationary pressure on pricing, and we export our inflation to import deflation, which is why we export labor overseas. But if I can now deflate prices even more through the use of AI by reducing the amount of employment I have, then that's even better for companies because that'll help boost profit margins long term. So, it's the stock is consolidating a massive run that it had. It's technically it's still in a very nice uptrend in the markets. Support levels of where it's are on Thursday. It's the Mag 7, Nvidia, Amazon, and Google pretty much kind of leading. kind of leading the pace today, even though the rest of the market's down 80 bips. Amazon's up nicely, Tesla's up, Nvidia, Apple, Google, Meta. It's those stocks that are green today, the rest of the market is red. And that's because managers have to have a place to go, and that's a highly liquid place to hide money. So again, no, Nvidia on a technical basis is getting pretty oversold here. You're probably going to get a decent entry point for investors to put capital to work back in Nvidia, and you're going to see large cap managers do this. Large cap managers are underweight technology, so when they've got to increase their tech weights, it'll be Amazon, Meta, Google, Apple, Nvidia that are getting those weighting structures.
Okay. All right. So you don't sound particularly worried about the issues that I mentioned. So is there a point here that you expect to get to in the relatively near future where if price does come down even more and those folks start buying, will you be one of them?
Yeah. No, we've decreased our weight in Nvidia twice just since July. So yeah, at some point here, our portfolio is now underweight Nvidia relative to where it's supposed to be relative to a 60-40 allocation, for example. So yeah, at some point, if this stock bottom starts to turn up, we get a positive buy signal on it, absolutely, we'll add back to our position.
Okay.
But that's our job, right?
Right. No, it's exactly your job. Okay, so to the headlines that I mentioned that you guys have been writing that are cautionary, we'll say, how do you want to tackle those here?
Well, it's fine. And again, yeah, they're cautionary for 2 months. So
Yeah.
you got to kind of keep these in perspective. Is that yes, there are some risks going into the election for the month of September and October. Markets tend to be weaker, and when you have a very divided political dynamic going into the election, there's a very high probability that portfolio managers are going to go, you know what, I don't know who's going to get elected for sure, but Kamala Harris is talking about a 20% corporate tax rate. Donald Trump's talking about 21% on corporate taxes. There's conversation about potentially trying to tax capital gains. I don't know who's going to get elected, but I don't like either one of those policies, right? So, I'm going to de-risk a bit because I don't know who's going to get elected. And it really doesn't, all these policies they talk about, mind you, mean nothing. Most of these policies they talk about will never get passed. And the only way they get these things passed is that Kamala Harris, as an example, she wants a 28% corporate tax rate. She's got to win the election and she's got to get control of House and Senate. If she doesn't, so really the important vote is not for the president, it's for the House and the Senate. So whoever controls House and Senate is going to set policy for more than anything else. So again, a lot of these policies never get passed, but again, Wall Street doesn't know this for sure. They don't know for sure who's going to win Senate, who's going to win Congress, who's going to win the presidency, what that means for policy. So historically, markets tend to de-risk a bit. So 3 to 5 to a 10% correction before the election. We're down about 3% from the recent peak already. So we're kind of in that process of working off, kind of this, positioning in the markets and getting markets back to oversold. We just triggered a MACD buy signal, a sell signal, on Wednesday. So there's certainly pressure to the downside in the markets right now. But once we get through the election, also can't forget the most important thing, as of today, September the 5th, corporate buybacks closed out. The blackout window for corporate buybacks starts today. So all that support. Now, ironically, if you go back and look at a picture of the markets, well, here, I'll just show you a picture of the markets because just happen to have it handy here. So this is the market right here at this bottom of the market during this yen carry trade blow up everybody was so freaked out about. That was where the buyback window for corporate buybacks reopened. And then, of course, we've had buybacks going ever since then. They just closed today. And then, now, not all of them. This is the start of the close of the window. By the end of the month, the vast majority of companies, including Apple, Microsoft, Google, et cetera, will be in the blackout period for buybacks because they're going to start announcing earnings. By the time we get to the end of October, all those buybacks will reopen. Those windows will reopen for buybacks. And that's why you'll get, post the election, you'll get a rally in the markets into year end because now policy is known. We know who got elected. We know who controls House and Senate. Buybacks are opening up, and I've got clarity potentially on earnings and taxes going into next year. So a portfolio manager will begin repositioning their portfolios into the end of the year for the sectors and markets that they think will perform best under the new presidency.
All right. So again, lots of reasons to expect that things might get rocky between now and the election, and then for the reasons you mentioned, bouncing after the election. Okay, so is that pink circle up on top on the MACD? Is that circling the sell signal?
Right, that's the sell signal. And we just now, again, this is so very important. So for you amateur technical analysts at home, your professionals watching the video, how I do technical analysis is probably not the way you do technical analysis, right? So for us, we're not technical traders. So we're not looking at technical analysis going, okay, I've got to buy or sell the market in general because of A, B, or C. That's not how we use technical analysis. Technical analysis for us is a measure of risk that we're looking for relative to our portfolio. Do we need to increase risk in our portfolio or decrease risk in our portfolio? That's really what we use technical analysis for. So again, if you may disagree with the way I do technical analysis, but the way I do technical analysis is built for our portfolio. So again, we have specific measures that we use. We have specific timeframes we use. We're not day trading. That's not our job. We're long-term investors. For instance, we own Nvida, or even better stock. We've owned Costco since we bought it originally when we started this particular portfolio model on SimpleVisor was in January of 2019. We've bought and sold around the edges of Costco the whole time, but we've never sold it. Our goal is to buy stocks that we love and hold them for a very, very long time. And what we use is technical analysis for is to know when to reduce exposure to that stock, in other words, take profits, or increase exposure to that portfolio by adding to it, over time. And so that's how we use technical analysis. So with that caveat, we've got a sell signal in the markets. We're just taking out on Thursday the 50-day moving average. That doesn't matter. It's Thursday. It doesn't matter. What we're looking for is does it break that support level by the close of the week? What's important is how the week closes, not how the day closes. And so if tomorrow on Friday, the market rallies tomorrow, we're back above the 50-day, this break is invalidated. What we're looking for to confirm the break of the 50-day is a break through that 50-day that then retests it and fails. So really good example of this was we broke the 50-day back in July. And immediately it's oh my gosh, we've got to, we need to sell. We broke the 50-day moving average. Well, we did break it for one day. The next day we were back above it. We rallied to the 20-day, failed, and then broke it again. So when you broke it that second time, that was okay, there's something definitely going wrong. You need to start reducing exposure. Now, we had reduced exposure previously to this because we were worried about the summer anyway. So we didn't have to do anything at this point, but that's the kind of action you're looking for. Is you're looking for a break, a retest, and a failure of that moving average. So again, you don't want to knee-jerk these breaks when they occur. It's like, oh my gosh, it broke today. I got to sell everything or whatever it is, because and this is one reason why people poo-poo technical analysis. They go, oh, it doesn't work. I tried it. I broke the 50-day moving average. I sold all my stuff, and the next day the market took off running. Yeah, that happens a lot because by the time that you're breaking these averages, in a lot of cases, the markets are oversold. And so you're going to get some type of rally. What you're looking for is a break and a confirmation of the break. And that'll help you keep yourself in positions longer and get head faked out less over time. But having said that, we've now triggered a sell signal, clear loss of momentum in the markets. And that really started occurring. And again, the article that's on the website specifically in the newsletter from this past weekend talks about this loss of momentum and why it could lead to a little bit bigger correction. So next level of support are going to be the 100-day moving average. If we take out that moving average, then we're going to retest the lows of August, which is right now aligning with the 200-day moving average. So we got a lot of support around 51.41. If we go peak to trough on that, that's about 8%. So again, that's where we get to that before the election potentially. we get a decline that is somewhere around 5 to 8 to 9% before the election.
Okay. All right. Well, folks, we'll be tracking this weekly here with Lance going forward, so we'll get a chance to see, how this develops in real time.
Yeah.
All right.
And again, again, just real quick. I mean,
Yeah.
this correction that we've been writing about for 2 weeks is here. We've started the correction. The question is how far does it go? Where does it bottom? And where's the next buying opportunity? That's what we'll be talking about.
Okay. All right. So, yeah, so pick up your ears, folks. We've started the correction, just a matter of how far it goes down from here. All right. So I want to just talk academically for a moment about something that you mentioned earlier, Lance, which is let's just assume for a moment that the proposed new taxes kick in. So the capital gains tax doubles, corporate tax rate goes up. And let's just start with those two, but then we'll get to the and what if unrealized gains actually start getting taxed as well? Not saying it's going to happen. I'm just saying, what would you expect to happen as a market technician and an experienced person with an experienced understanding of the economy?
Well, I mean, look, if there's it's interesting, right? I mean, we founded this whole country on the premise of no taxation without representation, right? Because in England, everybody was getting taxed to death. So they're like, okay, enough of this. Let's go form this new country called America, and we won't have any taxation without representation, blah, blah, blah. And of course, the first initial tax was 3% on the wealthy. And they're like, oh, we're just going to tax the wealthy 3%. And that's the way it always starts. But the problem with taxation is that it affects everybody. You're going to get taxed one of two ways. Either when you increase taxes, taxes get raised on everybody. So now everybody pays taxes. Regardless of your tax bracket, you're going to pay taxes. But this brings in the whole fallacy of, the rich don't pay their fair share. The top 10% of income earners pay 90% of the taxes. So what's the fair share? Should they pay 100% of all the taxes? Okay, great. That's their fair share. Nobody pays taxes but the wealthy people. Okay, so however you want to get there. But let's just assume that, right? So let's just assume now that the top 10% of income earners are the only people we're going to tax. You're still going to get taxed. Everybody's still going to get taxed from the bottom 90% down to zero. And the reason is that your cost of goods or services are going to have a tax. They're all going to go up in price because the income, the wealth producers, the people in the top 10%, those are your business owners, those are your corporate owners, those are your employers, those are the providers of capital for labor. That's where that all occurs. So if you want to tax them, that's fantastic. All they're going to do is include that tax in the price because they've got to generate a profit in order to stay in business. So everybody gets taxed down the line. So you're either going to get taxed through taxation or through higher prices, one of the two. And that's just the way economics is going to work. You don't get to there's no free lunch. You don't get to raise taxes on the top 10% of income earners and think that there's not going to be a pass through of those costs all the way through the line and down to the very bottom income earner, because they're all going to be compensated for that. Because again, you've got Wall Street demanding that Amazon or Microsoft or whatever, that they generate a certain profit margin. If you increase taxes, where do earnings come from? Earnings are after tax. I've got to pay my taxes. Then what I've got left over is my earnings. So in order to keep my earnings the same, I've got to pass that taxation through my cost. So taxations are basically a form of inflation.
All right, so I totally get that. So you're saying, okay, expect to see a pass through of any increases in the corporate taxes to everybody else, basically. I also believe, and tell me if you think differently, but capitalism works because it aligns incentives. And here, if you're basically telling producers, we're going to tax you more, you're decreasing their incentive to produce, right? So you'll likely see a decrease in production, right, which slows the economy, right?
or
Also,
or I shift my business to some other country, right?
that was
I shift my
my number point, which
headquarters.
is that, yeah,
Yeah, yeah,
that capital is mobile. Money will go, capital will go where it's best treated. And so we
yeah.
could see both a movement of corporations moving their activities outside the US where they to locales where they'll be taxed less, and maybe not inconceivable, a Microsoft someday, if it said, look, I'm going to get taxed to death in the States, it could move its headquarters to anywhere, right?
Yeah. Isle
Like
of
they have a lot of
Man,
factories that,
Jersey. Yeah,
yeah. Um, and then, as well, if you say, okay, well, capital gains are going to go up too, that's more individuals, same deal, right? And I think we've seen this a lot in history where when, people are getting taxed beyond a point that they think is tolerable, they will move their capital or move themselves and their capital to jurisdictions where it is better treated. So, these things sound great on the election trail stump. And to your point, Lance, I mean, these aren't things that a president can just, do on their own authority. They've got to get Congress to pass the legislation. So that's the big sticker here. But even if this stuff gets enacted, if you're sort of rooting for it, all right, let's stick it to those rich bastards. And again, I don't have a lot of love or sympathy for the elite that I rail about on this program very often, given that our wealth is concentrating in what I think to be a dangerous way into the hands of fewer and fewer pockets. But I don't think that this is the silver bullet solution. And not only do I not think that, I've not talked to, an experienced economist or anybody with a real understanding of history of the many, many times this has been tried in the past, and it always seems to have the exact same outcome. And if it were easy, we would have done this a long time ago. So,
yeah,
to me, it feels like this is just, one of the reasons why, well, the big reason why I founded this program and why I believe you do so much media, Lance, is because our education system, if I've said many times, does a terrible job of teaching financial literacy, right? And to me, this just feels like one of those things that just gets packaged and plays really well with a populist audience that is angry but doesn't have a strong understanding of economics, or dogs. Dogs don't like it either. Um, but it's one of those things that's just there to like inflame and enrage the masses and get them wound up and say, yeah, you got my support, when everybody knows this thing does not have a chance in working.
yeah. Sorry about that. My wife came home for lunch apparently. So,
That wasn't your wife
but
barking.
yeah,
That was the dogs barking at your wife.
no,
Just
it's
to
the
be
dogs barking because she came home for lunch. They're protecting me, right? They're doing their job.
okay.
But yeah, and look, we've seen. Look, there's so many things that are wrong with the system that we can fix. And one of the big things that went wrong with this financial system, in particular, was in during the Clinton administration. He came up with this idea, and he goes like, CEOs make too much money, so we've got to cap salaries for CEOs at $1 million. They can't make any more than $1 million. And the problem with government policies is generally they have no idea of economics. They have no idea about how markets actually function. And so they pass policies to appease a certain group of people, right? So we want to, I want the low information voter. I want the low information voter to vote for me. So what would appeal to the low information voter? We're going to go after the rich people, right? We're going to give you more child care tax credits, and we're going to tax the rich more, and we're going to give that money to you. Well, that sounds great, except for the fact that it's a terrible outcome economically, the way it occurs. You're going to want, again, we talked about more child care is fantastic. All it does is raise the cost of child care everywhere else. You want to give people money, that's great. Whatever money you give people is going to get absorbed by the inflationary pressure that comes right behind it. You want to tax the wealthy more, that's awesome, except it just increases the cost on everybody else. So all these ideas sound great, right? We're going to solve the problem. And Clinton's idea was this way too. And his was, hey, these CEOs, they just make too much money. And by the way, the average salary of CEOs was about a tenth of what it is today back in the late 90s, because we're going to cap salaries at $1 million. See, this sounds great. but he didn't understand markets. He didn't understand economics. He didn't understand Wall Street functions. And so what Wall Street said is, great, no problem, cap him at $1 million. Let's talk about stock options and stock-based compensation, because that's how we'll do all the compensation. And then stock buybacks come back and help boost earnings per share to make sure that the stock option compensation becomes valuable. Because again, stock-based compensation is based on the price of the stock. If the stock options issued at $100 a share in terms of the strike price and the stock is below that value, those stock options expire worthless. So companies are incented to make sure, through accounting gimmicks, managing, et cetera, to make sure that earnings are always beating expectations to keep the stock price elevated above the stock option strike price so they get compensated. And by the way, that's what stock buybacks are for. Stock buybacks are not a return of capital to shareholders. That is the biggest bunch of hooey out there in the markets right now. The only people that benefit from stock buybacks are the insiders who are selling their shares of stock that was given to them back to the company to capitalize on that stock issuance. Stock buybacks don't help you personally. You can sell your stock any day of the week in the market. When did you get a call from Apple saying, hey, I'm buying back stock, would you sell me your shares? It doesn't happen. The only people, and the SEC did a study, found this out, by the way, that the only people benefiting from this are insiders. But all this is part of that compensation game. So you let the genie out of the box, or out of the bottle in this case, and now you're trying to shove them back in through higher taxes, and that's not going to work.
Okay. Yeah, and I guess what I'm underscoring
Sorry,
here
you got
is,
me off on a rant. That's a really touchy subject for me.
yeah, no, I get it, and I feel the same way. And so, we'll see. Personally, I don't think proposals of the ones that we're talking about are helpful, and they have challenges to passing, as you've mentioned, but it doesn't mean that they won't at some time, or that something of the same vein will pass for the reasons you're mentioning, right? It's done to be politically expedient. It's done to obviously get votes for an election, and a lot of times, like I said, it's done because, as challenged as I think the average American is in their financial literacy, because our education doesn't teach it, I oftentimes think that the level of financial literacy and economic literacy of our elected officials is even worse, right?
Yeah.
But I think there's also a number of times where these policies like these are passed for political gain or expediency, and in some cases, I think they know that it's not good for the long haul, but it's politically convenient for them in the short term. And hey, if it has implications, that's going to be years down the road. That's going to be somebody else's problem to deal with, right? And I almost don't know which is worse. Is it the ignorance or the ill intent? I don't know, but neither is good.
Well, and again, you have to remember that politicians don't cater to high information voters, because those are very small in terms of numbers. I can't cater to a high information voter because I won't win the election. So I have to cater to the 98% of the population that are basically low information voters. If you ask most voters right now about the policies of either Trump or Harris, they have no idea what their policies are. All they're voting for is, I don't like Trump, or I like Harris because she's a female, or she's a woman of color, or I'm going to vote for Trump because I like him from before, whatever. But it's a personality contest more so than it is a policy contest. And what people are voting for is, hey, I'm promising you a whole bunch of free stuff, whatever it is. And so if you take a look at what's being promoted on the campaign trail, it caters to people that really don't have an inclination about what these policies actually mean longer term. No, there's no kind of consideration for the cost of what these programs will do. There's also no consideration for really what the economic benefit or detriment that will come out of these proposals. Like, one of the things that was floating around previously was price controls. There's no point ever in history that price controls ever worked out well for anyone. But most people don't know that because they don't know history, they don't know economics, they don't know politics. They're just simply saying, oh, well, you mean my price of bread won't go up anymore? That appeals to them. right? They have no idea what it's going to cost them their job and everything else they have down the road. But the price of bread not going up certainly sounds good right now.
Yeah, which is so, it's just really getting our rant on, but we live in the digital age where we have more information available at our fingertips for free. And yet society probably is a more low information society today than it's been in the past years, right? I mean, it's such an irony. And look, I'm not, we're not trying to make any partisan commentary here on what we're talking about, but like,
No,
we should have more
reality.
opportunity right now to know the most about each candidate. And we don't. And part of that's because, we choose to look at cat videos and stuff like that, on these devices instead of doing our research. But also part of it too is like just the way that politics have the brinksmanship has evolved here is like, I think we're going to have the least number of debates leading up to this election probably in history, right? I mean, the number of press conferences and debates and forums for which we could really delve into policy, we're not having. And largely because I think both candidates, they kind of know their constituencies, and debates almost become a point of vulnerability for them, where I actually might say, I might make a mistake and say something that gets, spun the wrong direction. So I'm just going to let my base, love me, and then hopefully I'll be able to get them out to vote more than the other person, as opposed to like, hey, let's really sit down and, have a discussion of ideas and ideals and, what we plan to do and all that type of stuff. So there's a lot that conspires today to keep us low information, which is crazy.
Yeah. No, it is. Like, and when you look at the vast majority of Americans now, like 60% of Americans get their news off of TikTok. That really tells you kind of where we've devolved to in terms of, where we're sourcing our information, the people we're looking to as information providers. And I can't tell you how much data that I see, on social media in general that is just flat out wrong.
You're wrong. Yeah,
It's
exactly.
not the way it's not the way the economy works. It's not the way the market works. But and it's interesting. There's a lot of financial channels out there that are by people that have never been through a bear market. They're young. Nothing wrong with being young, by the way. Not bashing being young. I wish I was younger for sure. But like their first endeavor into the market was in 2015, 2014, 2016, and so all they've seen is a bull market, and they're making this commentary about, oh, buy these stocks because they're going to go up next year because of A, B, or C, and there's no real understanding of fundamentals or earnings or the
Right.
type of things that matter
Right. In a
to
heavily
the
distorted bull
markets and
market,
earnings.
right? What
Yeah,
one where we had,
very, very
just
much.
unprecedented, injections of
Yeah,
sucker and capital and liquidity from our monetary and fiscal officials, right?
absolutely. And so, but again, this is what we always, we saw this in 2000, 4, 5, 6, 7. We saw a lot of people after the dot-com crash, advisors, cranked up their businesses, after the dot-com crash and thought they had the, tiger by the tail. And then of course, 2008 comes along, and we see this regularly, and these people won't be around, after the next crash, when it occurs, and it will. Look, at some point in the future, it may be 5 years from now, it might be 10 years from now, it might be 15 years from now. But we will have another secular bear market period where stock prices go 5 to 10 to 15 years of nowhere, right? So that's going to happen for sure. It's just how markets have cycled ever since 1871. And if you go back to 1871, they're very clear secular bull market periods, followed by a bull market period, followed by a bear market, followed by a bull market, and they just go back and forth. We're in a secular bull market period that began following the secular bear market period from 2000 to 2013. So we will have one of those periods again, 13, 14, 15 years of where returns are zero, lots of volatility. And a lot of these people that are in the markets today won't be around anymore because they don't know how to navigate that cycle. And this is going to be one of the, and this is why right now we have to understand that we're in a secular bull market. prices are trending higher, and they're going to continue to trend higher for a lot longer period than you probably think, until we get to whatever the next catalyst or exogenous event that occurs that brings us back into a valuation reversion period or valuation contraction period that'll last over a period of several years. But again, when that starts, could be 2 years from now, could be 5 years from now, could be 10 years. A lot of that will depend on policies passed on taxes and a variety of other issues through the government.
So let me ask you this, Lance. I'm curious. What do you prefer to be a capital manager in? The current market that we're in, where more often than not, you can just sort of throw your line in the water and know you're going to catch a fish, but you've got this sort of Damocles hanging over your head where you're like, but I know the price of this is that at some point, you know, the fantasy's going to get broken, and I'm going to be at risk of some big getting caught blindsided by some big correction, or a valuation-based market where you got to do you really got to do your due diligence to pick the diamonds from the rough, but you can feel like, okay, I feel good about that. I can trust this investment more because the market's playing the fundamentals, and I feel like I've done my research well.
It doesn't, this is obviously, I don't have to work near as hard in this market than I do in an actual bear market. I have to work a whole lot harder, do a lot more research. But honestly, it's the same process on either side. The only real defining moment is, or defining change, is whether I'm buying value stocks or growth stocks. Right now, I'm buying more growth stocks because that's what's working in the markets. At some point, we'll get to a valuation market and we'll buy value stocks. And so we'll have to do more research on the value side. But unfortunately, the real challenge isn't the money management side. That's not what's hard. What's hard at that point is the client side, because you're talking when markets don't go anywhere, and again, they just chop up and down for a period of time. They're like, oh, I'm not making any money. This market sucks, and I'll just go sit in cash, whatever it is, and they start making bad decisions based on that chop in the markets, and we'll go through one of those periods again. And again, we saw the same thing in 2008. I had this big bear market. It was fine. The challenge wasn't the managing the money part. The challenge was getting people back in the market after we had reduced exposure dramatically through 2008. The hard challenge was getting the clients back in the markets, because they were convinced that the bull market was over forever and it was never coming back. And so that's the hard dynamic, is navigating client psychology through one of those phases.
Okay. All right. Well, look, I'm going to start trying to land the plane here. Real quick, though, when we were talking about the level of financial illiteracy on Capitol Hill and on behalf of our elected officials, one of the amazing things about America is that anybody can become a leader, right? Anybody has the potential to become an elected official, right? You can be unhappy about the system and raise your hand and say, you know what, I want to make a difference, right? And you have the potential to get elected.
True.
But that also means
you have
that
a few $1 million.
Yeah, well, I mean, that's more the reality today, right? But that also means that there's no requirement set, right? In most cases, to become an elected official. And I don't know. Like, you and I had to take securities regulations exams to do what we do, to basically prove and demonstrate that we had a command of the knowledge that the industry regulators want us to have to be doing what we're doing, right? And I don't know. I mean, yeah, I feel like if you want to drive a car on the road, you gotta pass a driver's test. If you're going to be passing, passing legislation that influences how the nation's wealth is being allocated, you should probably demonstrate some financial literacy. Should there sort of be like a Series 65 or Series 7 test that elected officials, at least Congress people, need to pass? Like, okay, great, you won your election, but until you can vote on this, you get to pass this test.
I'm all there with you. First of all, I think you should have to pass a test to vote. To start with, there should be a basic exam on, kind of constitutional political policy, right? In order just to vote, right?
We
So
do
at
that for
least
immigrants, right? For legal immigrants, they have to pass
yeah,
that test. Yeah.
yeah. And so, if you're going to vote, hey, I think everybody should vote, right? But if you're going to vote, you should be a citizen because that is part of what the nation is, right? So the citizens vote for the elected officials. So you should have to prove your identity as a citizen to vote. And then secondly, you should pass a mind. I'm not talking about difficult, right? But just name the three branches of government. Simple stuff. Just understand the basics of how the you know a economy and a political system works. The fact that we're not a democracy, we're a constitutional republic. Those just basic questions. Okay, you've got some basic foundation. At least you paid attention through class in high school. Okay, so now you can go vote. Kind of like getting a driver's license, right? We just don't let you go drive a car. You got to get a driver's license. You want to vote? Very important, but that's never going to happen. But again, I agree with you. It would be nice that the people running government had some type of backbone. And look, and this is why I think, we should go back to electing military leaders to being the president. And the reason is what military leaders are well aware of is they know their limitations and they know how to delegate. And instead of getting
Sorry, by
people
military
into
leaders, you're not talking like a military dictatorship. You're talking like a Dwight Eisenhower.
no, like a Dwight Eisenhower or George
Yeah.
Washington or these guys that have served in the military, have commanded
Teddy
troops,
Roosevelt. Yeah.
particularly in battle. But they know how to delegate. They know how to organize. They understand what their weaknesses are, and they know how to go find a group of people saying, "Hey, I need you to go tackle this bridge," and they know how to put the right people together to go take that bridge, whatever it is. And that's why, if you go back in history, military leaders always made much better political leaders in terms of getting done because they don't just hire all their buddies to come be in Congress and all this. They actually go out and spend the time to find the best people to manage what it is that they need to get done within the government. But again, you need people that are who you're electing president. They need to be leaders. They don't need to be dividers. They need to be uniters and saying, look, we've got, Ronald Reagan was great at this. He wasn't a military leader, but he was a great uniter. He was able to reach across the aisle, say, hey, we've got issues to tackle, and we need to come together and get this done. And, he did a great job of doing that. And we need more people like that. John F. Kennedy on the Democrat side was a great president. He was able to reach across the aisle, get things done, and move that ball forward, which is what we need to get back to instead of dividing the country over everything, race, gender, religion, everything else, calling each other's names and saying, oh, they're a MAGA extremist or there's a left-wing nut, whatever it is. Instead of doing that, saying, hey, look, we're all citizens here. We've got a problem economically, and we need to start building real solutions to solve these problems. We need to lift the economy back up. We need to, growing at 2% economic growth is not where we want to be economically. We want to be growing at 4 or 5%. We need to start doing the things that get us back to that type of economic growth in the country. And you're not going to do that simply by dividing everybody down partisan lines.
Well, I agree, Lance, and I suspect virtually everybody watching this video agrees too. Let's hope that we do head in that direction. Like you, I don't think my idea of like Series 65 for incoming elected officials is ever going to happen. But I hate the fact that I feel that way because what is the argument against it, right? I mean, why would you argue, no, let's have less informed people, be making financial decisions for us, right?
It's the same reason people argue against having IDs to vote, right? You've got to have an ID for everything, right? You want to go to, it was interesting, the very people arguing against having an ID to vote are requiring an ID to get into the conventions, right? You've got to have an ID to get on an airplane. You've got to have an ID to get on a train. You've got to have an ID to get food stamps or to do anything else. That doesn't, apparently having an ID to get, welfare or to get on a train or to fly on a plane, that doesn't disenfranchise people, but apparently having an ID to vote does. And so the arguments don't hold water. But again, this is how we divide people and keep everybody, arguing with each other, so we can't come together cohesively to fix problems. And these are the things that we have to look through as individuals and saying, what is the benefit of this policy, whatever it is? And again, so as we start looking through this, is it really just the goal of just making sure your party gets elected? Or are we really trying to elect people not based on party politics or party identity? Or should we be electing people to actually start fixing the problems within the economy so that we create better economic prosperity for everybody? I mean, shouldn't that be our real goal?
Oh, absolutely. Well, anyways, like I can't wait until we're through this election season and hopefully we touch on politics a little bit less in this stuff. All right. Well, look, trades. What trades, if any, have you guys made over the past week?
I'm trying to think off the top of my head. I don't think we did any trades. Oh, we did no trades this week. That's right. I forget. I keep forgetting this is a holiday shortened week. You're a day early. So everything's off schedule this week. So no trades this week.
Okay. And as you look towards next week, are there trades that you're contemplating making, or are you guys more in a wait and see mode right now, given the sell signal and where you think things may head?
It just depends. I mean, right now we're pretty well positioned. I would love this correction to come down a little bit more. We're underweight equities right now, and look, I would love two things. I would love a correction in bond prices and a correction in stock prices. Again, not anything major, but a 5 to an 8% correction would be a great opportunity. There's some stocks that we want to add to. We recently added Annaly Mortgage to our portfolio for the Fed to start cutting rates. That's in a great position right now. Has a 13% yield. I would love to add to that position some more. We own a couple of utility stocks that are super overbought right now, but I would love to buy some more of those on a pullback. I would love to add back to Nvida and Amazon and Microsoft and AMD and others that we sold recently. I'd love an opportunity to add back to those guys as well and rebuild our portfolio. But again, we're just not in the right place for that just yet. So hopefully we'll get a correction here before the election that'll let us get set up for the end of the year.
Okay. And I think I asked you this last week, but just to scratch the itch again for folks that have it, what yields, and I know you said you don't really look at it this way, but what 10-year yield would you be looking at to say, okay, look, this is beginning to feel like a pretty good entry point?
It's hard to say because again, there's two, as is always the case, there's two ways to resolve an overbought condition: time or price, right? So if bonds just trade sideways, and let's say they just stay at 3.78%, whatever they are right now, for 2 months, then we'll work off a lot of that overbought condition in bonds, and 3.78 may be a good buying opportunity. It's not a good price today, but in 2 months it could be a great price, even though it's the same price. And this is part of understanding price dynamics. This is where a lot of investors go wrong. They go, well, I don't want to buy it here; it's too expensive. And they don't realize when they go through a correctional process that just goes sideways for a period of time. Nvidia is a good case of this right now, just kind of going sideways. And that works off a lot of that overbought condition. And so, people are going, well, it's still very expensive from where it was. No, it's a lot cheaper than where it was just 2 months ago because of this price grind that it's been in now for the last 2 months. So again, it's important to understand the importance of time. But if you said, Lance, what would yields be for you to buy it tomorrow? I'd say about 4.1% on the 10-year treasury. 4.1, that would be a price correction, and that would happen very quickly over a couple of days. And so if we jetted up to 4.1% on the 10-year treasury in the next week, that would probably be a decent buying opportunity somewhere in there. Now we'll know when we get there, but that would probably get us in the ballpark. Okay,
so if those aggressive traders betting the millions that the payroll report's going to be blockbuster and yield spike to that level on next week, you'd be out there buying an RIA.
Yeah, I would. I don't expect that to happen. I think the traders are probably going to be wrong. And also too, just by the way, be really careful with that type of data. You don't know why, for real, that they're putting on these bets.
Right,
They
just
may
to
not
be
be
ahead.
betting.
Yeah.
It could literally be a head. Like for instance, bonds are very overbought. So if, in my bond portfolio as an example, or our platinum model where we run options, one thing I could do is go in there and buy puts or write calls that would look like I'm making a bet on prices move higher, but I'm really just hedging my current bond position. So again, you've always got to take that kind of data with a grain of salt.
Okay. All right. Well, look, great as always, Lance. Because you didn't have that many trades, I'm going to squeeze in another rant here, but this one will be quick because we already kind of pre-ranted on the political side. But as I mentioned, my 25th business school reunion is happening tomorrow. My youngest daughter, is leaving for college in 2 weeks. So there's a lot of things going on in my life right now that are just making me reflect on the price of time, about how of all our assets, that really is the one that has the greatest value, right? Because we just have a little bit less of it every single day, right? And I was talking with my mother-in-law about this the other day because she had her birthday, and she's now in her mid-80s, and mid-80s or close to her mid-80s, and she was making some comment about the election, and I just said, "Hey, I got to ask you this question." I was like, "Help me understand why generally the older people get, the more worked up I see they get about the news and politics and what's going on." And I'm like, I get it. Like, for a lot of people at that age, the older you get, you don't have that much else to do except kind of read and watch TV and track what's going on. But I'm like, you're not going to be around to see how these policies end up, right? Like, you're getting near the end of life. Like, no matter what these people put in place, when those shoes drop, it's not really going to be meaningful to you, right? So I'm like, I've always been amazed by that and surprised by it, because I would think the older you would get, the more that you would place your focus, the more you would let that stuff go and place your focus on the things that are going to be, or that are most meaningful to you in your last years. What's happening in your community, with your family, locally, that type of stuff. And look, I'm painting with a broad brush. Not every person does what I'm talking about there, but it really just sort of made me think that, as Americans or Westerners, we oftentimes really misprice time. We act as if we have much more than we do. And so a lot of our interactions tend to be much more superficial than they were if we really truly appreciated that time is limited, right? So, why not focus on the things that we would miss that we'll miss the most when we're not around? And, why not have the conversations that we would regret not having had if suddenly our time got cut short, or the people in our lives' time got cut short? And kind of a good exercise to go through, at least a mental one, but I think everybody should do this, is you practice kind of the last day on Earth exercise. Like, if I were just told this is my last day on Earth, would I spend a lot of time watching TikTok videos and railing at, the presidential candidates? Or would I be like laser focused on doing the things that I love most for perhaps the last time? And when I talk to people, would we just chit chat, or would I say, hey, these are the things that I really want to dig into you and make sure that, have been left expressed between the two of us? And look, you're not going to have those types of conversations every single day with somebody once you've had them, but for sure, make sure you have them. And then, your future interactions are still, have fun, but are really focusing on, am I using this time well, right? So anyways, I'd love to hear your thoughts on this, Lance, and just to see that, like, I know your father passed away, when you were younger in life. Like, if suddenly you could spend one more day with him, what are the things you guys would talk about? I'm pretty sure you wouldn't be talking about the economic policies of the upcoming election, right? I think you'd be drilling in on things that are much more meaningful for you, right?
Yeah, and look, where I am in life right now at my age, I really don't care about politics too much, because no matter what happens, it's not going to affect me and my wife that much at the end of the day. I mean, if y'all want to go all socialism, y'all can go all socialism. That's on y'all, right? It's not really going to change my life all that much. It may change my taxation a bit, but as we talked about before, money is mobile. And In a past life of mine, I used to manage high net worth clients in France who have an 80% tax rate. I want to talk about socialism and how that works out. The average tax rate's 80%. And so what I did is for high net worth investors that lived in France, I managed their money outside of France. And so when we did transactions, everything was keeping it offshore. So I know how to do all that. I know how to set up, offshore accounts and manage money out of jurisdictions and all that type of stuff. And that's the great thing about money is it's very mobile, right? Opening up bank accounts today more than ever is super easy. Get on an airplane, fly overseas somewhere, open up some bank accounts, fund them, and
Right.
you'll pay taxes.
Buy your Bitcoin,
Yeah.
hop on a plane, and
And there you go. So look, I'm not saying I will do that, but I'm just saying is that is, this is the thing that we mistake in policy about wealth is, and you said this before, wealth is mobile. I can reincorporate my business tomorrow in the Isle of Man and change, all of my tax jurisdiction, right? So that's the thing that we forget. It's like, let's go after those rich people, and that's awesome. Y'all can go all socialism. It's not going to change my life. It'll make things difficult for a year or two until I get things reorganized, but then after that, it's not going to faze me a bit. I'll do these videos to the beach somewhere in some other country. And I'll give you a better background, right? You'll have a beach. But what I worry about, and the reason that I do pay attention to politics, and I think this is the case with, people that you've talked to that are older, is I worry about my kids.
Right. Yeah.
They're the ones that have to grow up with the trended policies that we're heading towards. Their opportunities to build wealth are being diminished. Their abilities to capitalize on one of the greatest functional systems that the world has ever seen is being severely limited. Now, that doesn't mean they're all going to be millionaires and billionaires, but the ability to make several $100,000 a year is being severely diminished. And so I do, and I have these conversations with my kids and saying, look, you have to understand these policies that you're voting for. It's not just, I want to do this policy because it makes me feel good today. Think about what this means for your future and what that means for your future and what that's going to look like down the road. Because again, there's no free lunch. If you want to give money to somebody for something, somebody else has got to pay for it. And so the harder that, the more money you want to give away, the harder that people have to work to earn that money to give that money away, which makes that much less appealing for people to actually promote the system. So you keep moving more and more people towards the giving side, right? I want to be on the side of the economy that just gets free stuff versus the production side. And this is why socialism never works. It always divides the country, creates a lot of people that take from the system, but limits the amount of people paying into the system. And that's what you've got to have to make socialism work. And it just, and so that's what I worry about with my kids is, and the reason I pay attention to what's going on, because it's not me, none of this is going to affect me. It's going to affect my kids and their kids, and that's what I worry about.
Yeah, and I think, probably most people watching this video, feel the exact same way as you. And, I'm not saying that, hey, if you're a senior, you should be completely disinterested, what's going on politically. We all, I think most of us worry about our progeny and what's going to happen to them. But to my point is yeah, rather than kind of just binge watching the major networks and getting your blood pressure, boiling, 8 times a day, take that energy and just spend it with your kids and grandkids because that's a limited time. Make as many wonderful memories as you can, but also, have meaningful conversations about these concerns and say, hey, look, let me help you become more educated, more literate financially so you can make better decisions. And maybe your time is better spent, putting together some trusts or, things that basically, hey, if some of these dominoes I think are going to fall in the future, I can at least provide some help beyond, my natural lifetime to you and your children, right?
Right.
So anyways, the whole point is just to really appreciate what we have and to use the time as constructively as possible so that when the end comes, you're not regretting the fact that, oh my God, I could have spent a lot more time with them, or I kept things way too on the surface and superficial. And yes, family's super important, but I even mean this too, just in your relationships. And I think we do a pretty good job, Lance, when we're talking to each other about being direct and, being honest with each other about the good and the bad and whatnot. But I try to actively practice that in more of my relationships, because more often than not, if I'm honest with myself, I'm like, you know what? Yeah, when I'm just hanging out with guys, it's fun and there's nothing wrong with just hanging out and having a good time. But like, yeah, there's probably stuff I wish they understood, and most of it's usually on just how much I appreciate them or the value I get out of the friendship or my hopes for where things could go. And yeah, if I'm being honest with myself, I don't do a good enough job of really seizing those opportunities when I have them. And that's kind of
Yeah,
the
that's right.
if there's sort of an ask I have of the viewers today, it might be like, all right, so pick somebody in your life today that you could really just say, hey, look, not trying to be weird or anything, but
I
let
love
me
you,
tell you some
bro.
of the things that are important for you to know about me right now in this moment. Yeah,
Yeah.
yeah. All right.
No,
All right.
it's very true. That's very
Well,
true.
and we talked about I won't go off on it now, but we've talked about Sebastian Junger in his book Tribe and the importance of community to humans because we're social animals and all that stuff. That's why relationships are the number one thing that we value more than anything else. And he would
Yes.
talk about how the biggest issue with like soldiers coming home is not so much the PTSD as it is you're living life the way that humans evolved to live it when you're in a combat zone. You come home and everything is so superficial that people just feel super disconnected from others in the world because everything just feels so fake and false, right? And I guess that's what I'm trying to address here. And just let folks know, I've actually been in touch with Sebastian. He has agreed at some point to come on, and we're going to do an interview talking with him about this. And Lance, if you're interested, I'd love to have you in that conversation if you want to be.
Yeah, absolutely. That'd be awesome.
Okay.
Yeah, definitely.
All right. Well, look, another great week. If folks, if really the thing that brings you the most meaning in terms of your relationships is getting to hear from Lance Roberts on this channel week after week, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. We talked an awful lot here about what may or may not happen in the markets going forward. If you are a regular person, meaning you've got a job, a family, real world demands, and would like some help in figuring out how to navigate what might lie ahead, highly recommend you get that help from a good professional financial advisor who understands all the issues that we talked about here. If you've got a good one who's doing that for you and executing it on a personalized portfolio strategy for you, fantastic, stick with them. But if you don't, you'd like a second opinion from one who does meet all those criteria, perhaps even Lance and his team there at RIA, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the short form at thoughtfulmoney.com. The advisors will reach out very shortly after you fill out that form. Lastly, just a reminder, we are still offering the lowest early bird discount price to the upcoming Thoughtful Money conference. If you haven't bought your ticket yet, I highly recommend you do so soon because that early bird price isn't going to stick around forever. And a reminder too, that if you are a premium subscriber to our Substack, you'll get an additional $50 off of the price of the conference. To go sign up for the conference, just go to thoughtfulmoney.com/conference. Lance, my friend, thanks for another
All
great
right.
week. As usual, I'll give you the last word.
No, you just make me feel like I'm on like America's Got Talent when they get to the part where it's like you got to vote for the performer. It's like heart, call me, call the number, So yeah, give me those thumbs up so I can come back next week. See you then.
All right. Well, Lance, I'm going to use my golden ticket on you, my golden buzzer. So you definitely get to
There you
come
go.
back, my friend. No, thanks so much. Appreciate it. Again, you doing this a week
Yep.
early. Good luck setting up the final finishes around the home studio. It's awesome.
Yep.
And see you then next week, my friend. Everybody else, thanks so much for
Got
watching.